What signals the start of the next big economic downturn? Not just a slight slowdown, but a full-blown recession. The kind that shakes markets and leaves millions unemployed. Think about the yield curve, a reliable predictor that has preceded nearly every recession in modern history. It inverts, and then just as it uninverts, the countdown begins. But here's the twist. An uninverted yield curve doesn't always mean that a recession begins. Unemployment, for example, also has to rise in order for the dominoes to fall. For example, in past recessions, unemployment often started creeping up months before the economy crumbled. But what happens when that doesn't occur? Could this time be different? Or are we just a mere 3 months from the economic fallout beginning? And here's something you may not know. Most recent recessions have begun under a specific pattern of leadership. But you'll have to stick around to the end to see exactly what that is. In this video, I'll break down what an uninverting yield curve really means, how unemployment is tied to the bigger picture, and what steps you can take to prepare for the inevitable. Because while history often repeats itself, it also leaves clues for those that are paying attention. But before we dive in, my name's Nolan Matthias, and if you want the truth, the real truth about finance and economics, this is the place for you. And if this video gives you any sorts of insights on how to protect yourself from the next big recession, do me a favor, hit the subscribe button and hit the like button so more people like you can also see this video. Oh, and also tell me what you think. Are we headed for the next big recession? Or are all the signs in your opinion suggesting that we're headed towards the next big bull market? Okay, so let's get into it. Let's discuss the next big recession. Because yes, there are in fact signals that are pointing to another big decline in the US economy being just around the corner. The question is, will that happen? And if it does, how can we prepare ourselves in advance? Because believe it or not, there is still time to put your ducks in a row to make sure that the next recession doesn't destroy your finances. But in order to understand exactly what's going on here, we need to understand what everybody is talking about, and that is the yield curve. Because while many people talk about the yield curve and what it means to the economy, not a lot of people really understand the dynamics of how it works. So let's start by taking a look at 10-year versus 2-year bond rates. Most of the time, these short-term rates should be lower than the long-term rates. The 2-year rate should be less than the 10-year rate. But when the yield curve inverts, it's because these short-term rates have gotten higher than the long-term rates. And the reason for this is quite simply because of the action taken by the central bank, in this case, the Federal Reserve, where the Federal Reserve increases short-term rates in order to stop inflation. And while these increases to interest rates may not have a massive effect on the 10-year bond yield, they certainly have a massive effect on the 1, the 2, the 3-year bond yields, which tend to increase in line with the Fed's effective fund rate. And as you can see in this graph, when the Fed increases interest rates, that often leads to the yield curve inversion, where the difference between the 10-year and the 2-year rate goes negative. And these increases to short-term interest rates by the Fed are in fact designed to slow down the economy. But when the Fed goes too far and increases short-term interest rates by too much, it can often have devastating effects that end up happening after interest rates have started to come down. And what that ends up looking like is a yield curve that looks like this, where you see periods of time where that yield curve goes negative, and for the most part, everything in the economy seems okay. In fact, quite often, as we'll talk about later, the S&P 500 hits all-time highs as a result of that inverted yield curve. And as the Fed alters course and starts bringing those short-term interest rates down, people start to get a sense of confidence in the economy right before the recessions tend to happen, thinking that with interest rates coming down, things are going to get better. However, in fact, there's a lot of damage that is about to potentially occur. And to illustrate this more effectively, here's the 2-year and the 10-year graphed against the yield curve. And as you can see, that yield curve is negative when that pink line, the US 10-year rate, is below the US 2-year rate, which isn't supposed to happen. It only happens when the Federal Reserve is trying to slow down the economy. And inevitably, they often slow down the economy so much that we eventually end up in a recession. And you can see that quite clearly when we map recessions against the yield curve and the 10 and the 2-year rate. As you can see, going back to the 1980s with almost complete certainty, when the yield curve goes negative, we find ourselves in a situation where a recession is right around the corner. Now, this doesn't always happen immediately as the yield curve starts to invert. There's usually 2 to 3 months before the recession begins. And as you can see from this graph, we're starting to head to the point where the yield curve is getting back close to zero and is on its way to successfully uninverting itself. But what that means is that there could be trouble ahead. The question is, how do we know that this yield curve inversion is actually going to lead to a full-blown recession? And it turns out there's another piece of data that we can look at that has a strong correlation to these recessions beginning when combined with an uninverting yield curve, and that is unemployment. So if you take a look at unemployment when graphed against recessions and the yield curve, what you can clearly see is that when the yield curve is uninverting and there's also an increase in unemployment, well, that creates almost complete certainty that there will be a recession, at least in recent history. Now, does that necessarily mean that a recession is guaranteed? No, absolutely not. But the recent past tells us that it creates a very high likelihood. However, the unemployment tends to happen after the yield curve has already started uninverting. So it tends to be a lag indicator with respect to a recession as opposed to a lead indicator. But it is an indicator that you should be paying attention to, because if you do in fact start to see unemployment numbers increase, well, that could be a sign that we are in fact headed for a recession. And if you look back to 2008, you can see this very distinctly. The yield curve starts uninverting, everything seems like it's going to be fine, and then all of a sudden unemployment spikes, and we find ourselves in that significant recessionary period called the Great Recession, otherwise known as the financial crisis. And that unemployment number is going to be the number that markets are watching for the next couple of months in order to determine if we are in fact headed for a recession. And because this is a lag indicator, we won't know that it is indicating a recession until well after it has happened. It's important to prepare for the near future in order to make sure your assets are protected. And I'll show you how to do that near the end of this video. But first, let's take a look at where unemployment is today. Because in a somewhat scary plot twist, we are in fact seeing the unemployment rate in the United States start to increase. You can see that it hit its lows here in 2023, just as the yield curve started to uninvert. And as the yield curve is approaching that 0% magic number, well, guess what? This unemployment number is starting to rise as well, which means in the following months, if something is not done that corrects the unemployment trends, well, fasten your seatbelts because the recession might just arrive. And it's important to note that the yield curve and unemployment are almost identical graphs most of the time. Very rarely does unemployment buck the yield curve trend. In fact, if you take a look at unemployment when it is graphed against the yield curve, you can see that they almost line up perfectly, with unemployment almost all of the time increasing as the yield curve uninverts, as it's doing right now, and decreasing as the yield curve starts to move towards inversion. So if you look at this chart and you believe that history repeats, well, it becomes clear that we could be in trouble when it comes to unemployment in the coming months. But at the same time, people are pointing to the fact that the S&P 500 has hit all-time highs. And with the S&P 500 hitting all-time highs, that means that companies are doing well, which suggests that unemployment should not be an issue. And that may very well be the case. However, there's one thing to note. Before almost every single recession, the S&P 500 does in fact hit all-time highs. And if we punch this graph out back to the early 1990s, you can see this in action. Whether it was the oil shock in the early 1990s, whether it was the dot-com bubble bust in the early 2000s and late 1990s, whether it was the subprime mortgage bust, or right leading up to COVID, the stock market hitting all-time highs is by no means an indicator that unemployment is going to remain low and that a recession is not right around the corner. In fact, the stock market and returns in the stock market have zero correlation to a recession coming, with the exception of the fact that leading up to a recession, the stock market is almost always a lead indicator, turning negative a month or two before the actual recession occurs. And while a small drop in the S&P 500 is normal, consistent and multiple drops in the S&P 500 could be an indicator that we are heading for trouble. So if we can't look to the stock market as a lead indicator on whether or not a recession is coming, where can we look? Well, there's this thing called the SAM rule. And what the SAM rule says is that when the 3-month moving average of the national unemployment rate is 0.5 percentage points or more above its low over the prior 12 months, we are in the early months of a recession. Now, what does that mean? Well, let me show you. What it means is that when the SAM rule is graphed against recessions, you can see that there's almost always an increase in the SAM rule indicator right before a recession begins. So in other words, the SAM rule, which is a measure of unemployment, can be a lead indicator that a recession is around the corner. And I've got some bad news. If you take a look at the SAM rule currently, it's increasing in the same way that it did leading up to the 2008 recession, the dot-com bubble burst, and the recession in the 1990s. So all of this tells us that a recession could very well be 2 or 3 months away. Now, at the same time, we also have a change in leadership at the top, the President of the United States. And many people believe that the policies of the newly elected president are going to be good for the economy, because policies that reduce taxes and make businesses more likely to earn income should be good for the overall health of the economy, right? Well, let me show you the interesting data with respect to who was in power and the types of policies leading up to pretty much every recession in the last 30 or 40 years. Prior to every single recession in the last 35 years, there has been a Republican, a tax and business-friendly president in power. Now, there is some argument to be made that those presidents were left with the mess that was created by the previous Democratic presidents. However, it is very important to note that whether or not it was the fault of the previous administration or not, tax and business-friendly presidents have very little ability to stop a recession. Look at George H.W. Bush prior to the oil shock in the 1990s, George W. Bush, who was elected prior to the dot-com bubble, and who was also in power leading up to and during the beginning of the subprime mortgage crisis, and, well, Donald Trump, who, arguably with respect to the COVID-19 recession, had absolutely zero control over what was happening. But regardless, the next president of the United States is probably going to have very little but control over whether or not the next recession occurs, especially given that the timeline for a recession occurring after a yield curve inverts is definitely not enough time for a president to turn the tables on the economy prior to that recession happening. Now, the new president may in fact have the ability to lessen the severity of the recession, but if everything that we're looking at is true, the next recession is coming whether he likes it or not. So the question is, how can you protect yourself? And I've talked about it on almost every single video with respect to the economy that I've made in the last several months, and that is by using something called the all-weather portfolio, which was made famous by Ray Dalio. This is a portfolio that doesn't diversify necessarily for assets, although it does that as a side effect. It diversifies for risk, meaning that when the economy does take a nosedive, this type of portfolio tends to have less exposure than having all of your money in stocks, bonds, or having a 60-40 split. And if you look at the track record of the all-weather portfolio relative to having just global equities, you can see that the all-weather asset mix tends to perform as well as an equities-only portfolio, at least over the long term, with the drawdowns, which are shown on the graph on the bottom, being significantly less than what they would be if you were only investing in stocks. And what's a drawdown? Well, a drawdown is quite simply how much an investment nosedives when the economy nosedives. And while recently some people have questioned the validity of the all-weather portfolio, given that it has underperformed the S&P 500, you need look no further than the times in history where stocks did outperform the all-weather portfolio, only to have that performance come crashing down and bring it back to parity. And if you look at the last 20 years of the all-weather portfolio, you can see that yes, in fact, the yellow line, which is the S&P 500, is performing better than the all-weather portfolio and the traditional 60-40 split. However, when that next recession hits, there's a high likelihood that the drawdowns are going to bring it back to even, which means that if you have an all-weather portfolio right now with all indicators pointing to the fact that we are going to see another recession, and even if we don't, keep in mind it's only a matter of time, you'll be better prepared and less likely to lose a significant amount of your portfolio when the S&P 500 does drop because a recession is in fact on its way. Now, if you don't have an investment portfolio, this should be your sign that you should be saving more money. And that probably means spending less, saving more, and making sure that as much of your debt as humanly possible is paid off prior to the next big crisis. Oh, and if you want to see a video on what always happens before a financial crisis, make sure you check out this video right here.